Good morning. Hello. It is another episode of Southbank Live here in Cheddar. It is 10 in the morning. I'm joined today by John Butler. John, how are you getting on this morning?
Yeah, doing well, Boaz. You?
Very well indeed. The weather's not been quite so nice this week, but it's been quite a busy week. We had plenty to look at, certainly. I think this episode we'll be looking at gold really in a lot of detail, though we will be dwelling on a couple
Good.
other topics. It is a very special week. Well, this Sunday is a very special Sunday, and of course, it's been a very momentous week for gold with a very hard sell-off earlier in the week. John, just in terms of where we should begin with this, because of course there's so many angles one could dwell on when talking about gold, but just for everybody watching this, if we could put up a nice chart of gold on the screen here, if I speak to the man behind the curtain, and just take a look at what's happened over the past 10 days. So it is currently the 13th of August now. So this is a 10-day chart for anybody watching this in the future. So it is a very small time frame, but it has been a really very momentous week for gold. Not a very good one if you're a very bullish gold investor, of course, but it was a very dramatic sell-off indeed, John. And people have a lot of questions to ask. There are always lots of theories as to what exactly went on here, as of course now does seem like a pretty good time to be owning gold. That'd be my view, at least, though of course we don't give financial advice on this show. This is mostly for informational and occasionally entertainment purposes. But when there is so much evidence of inflation now that we've seen this week, something we'll also dwell on in this show, it does seem like a strange time for the gold price to get whacked like this. Now we can take the chart off and just discuss some of the things that happened here. John, can you give us a breakdown of the sell-off, because it happened at quite a strange time, didn't it?
Yes, it happened very early in the week's trading in the Asian time zone when, liquidity tends to be pretty poor. It might even be the worst time for liquidity throughout a normal week. And that, of course, seems a bit curious, whether you're buying or selling, if you're trying to get the best possible execution, you want the highest possible liquidity in the market. So, you don't end up moving it yourself and getting filled at prices that are not as attractive. Either side. So the idea that this was a deliberate gold slam, well, in this case, yes, the price was going down hard. That's what happened. But certainly, regardless of who was involved in that price action, profit maximization, best execution doesn't appear to have been the primary object of what went on.
Right. Very strange. So I believe it's $4 billion notional in futures that were suddenly sold. It's an awful lot of money. One would thought, if you had such a large position and you did want to get it off your books, you might not want to do it all at once at a time where there's very little volume. What would motivate a man to do such a thing, do you think, John?
Okay, look, if you're a really big player in the market, if you're a really big player in the market, okay, then you are aware that even at times of decent liquidity, you might still be a market mover. And so you have to be careful how you go about moving large positions, be they from the long side or the sell side. So one classic possibility here, and this is the sort of thing that regulators don't like, is that someone kind of banged the open, as it were. It's more often that you hear people talking about banging the close, but in this case, someone banged the open to try and shock the market lower, because in fact, what they really wanted to do over the course of the week, perhaps even a longer period, was accumulate a very large position. And so they wanted to try to create this initial slam panic sell-off so that they could then average in even greater amounts on average over time, over a 1, maybe 2-week period. Look, these things go on in markets. Now, they tend not to go on much in highly liquid markets, and gold does tend to be highly liquid, but there are times when it's not. So this is the sort of thing that regulators don't like, and the sort of thing that occasionally gets investigated.
Right. It does. Yeah, it does. It does ask a lot of questions. Just if I could ping your brain on a couple of what you just said, John. So if we're saying $4 billion notional in futures were sold, and say the individual or the organization that did this would want to acquire a lot more silver in the future, as you say, so they've banged the open in order to get the price lower, so that they can then average in at a nice lower price. How much capital do you think that entity would have?
Again, I mean, all of this stuff is done with leverage normally, right? I mean, this is not real money, but it's speculative capital being thrown around in various ways. And the sort of leverage that you can get in futures, I mean, it depends on, to some extent, on who you are, right? But it's perfectly normal for people to be operating with 10 or 20 times, or leverage, or something that order of magnitude is not unusual. And so the amount of capital you would actually need in that case to be moving on either side, to be moving 4 billion of futures, you have to have, you're going to be in the, you're going to be in the hundreds of millions, right, in terms of what you have at your disposal. But there are many entities out there,
Yeah,
who do have resources like that. And so it's, there's not just a short list that you would be looking at. And again, if the CFTC or any other regulatory body were asked to look into this, it wouldn't be obvious where to start.
right. Though you do, yeah, you do. Earlier in our chat, you did mention how profit maximization with that single trade, it doesn't seem to be something that whoever did it was really trying to. They weren't trying to make money if that was their main sort of exit point for.
If that single act alone, and I'm assuming there was only one seller. That has not been established, in my opinion.
Right.
One order could be a block order of many sellers, okay, who for whatever reason all wanted to unload at the start of the trading week. Okay, so even that I don't think has been established. But if it were one act by one seller, then clearly this was not a profit maximizing best execution event. It was designed as part of a bigger strategy, presumably, if it is ultimately a profit-seeking strategy, to average into a long position over a multi-day, perhaps multi-week period, trying to take advantage of what you hope is this wave of panic selling that you initiate by that large seller.
Yes, and when we're thinking of buying gold in this kind of environment, it does seem like a pretty good time to be doing it. From my perspective, at least, I did actually buy some gold yesterday. I was it did seem like a nice time, because we are seeing it's been such a really bad week for gold when you look at it from pretty much every angle in some ways. But John, when you're thinking of the environment for gold here being more positive, and why somebody might want to be banging the open and then accumulating a lot of it, it's been interesting seeing the inflation statistics come out this week, especially from the US. And I know this is something that's been puzzling you as well, because it doesn't seem like interest rates are moving to offset that in any way. So the heat is rising, and yet it's not there's not really a release valve for it.
No, indeed. And this is where the story gets a bit more interesting. With every CPI print that you get at a very elevated level, vis-a-vis what we've been used to over the past decade or two, that changes the psychology. Everyone can accept that 1 month is a blip, it's part of a base effect. 2 months is less of a blip and less part of a base effect. And indeed, the simple month-on-month seasonally adjusted rise in the US CPI during the month was 0.5%. If you annualize that, that's above 6%. That is a big number. Now, again, it's only a 1 month number, but it comes on the back of another big number. And to some extent, yes, we've already discussed this. To some extent, the year-on-year calculations are impacted by base effects, absolutely. But they're less affected now that we've had 2 of these big back-to-back months than they were prior. That affects the psychology of investors, that affects the psychology of consumers. And indeed, it also affects the psychology of the businesses that provide the products for those consumers. People start to change behavior when they start to think differently about the amount of inflation that's coming through the system. And that becomes a bit of a self-fulfilling prophecy. And that aspect of inflation psychology will change with every incremental month that we are getting prints like this. People will not see it as transitory, and they will change their behavior accordingly.
Right, and we did receive a couple of questions ahead of time from our readers. I'd like to read a couple of them out, especially on that topic of inflation, John. So Paul wrote in and asked, at what level of inflation does the gold price usually start to be effective? Are we talking real inflation or nominal? Is it USA inflation that we're talking about, or does UK inflation have an effect on the broader gold price? And he does ask to draw a money map a la Charlie Morris, one of our colleagues here at Southbank Investment Research, using inflation and where one is living and what they spend most of their money on, and how that would affect how much gold one should be buying, things like that. Of course, we can't give a personal financial advice here, but John, but just when it comes to at what level of inflation does gold really start shooting the lights out? At what level of inflation would be looking for? I think we can expand a bit on that for Paul.
Well, look, I mean, first of all, let's think about what inflation is, of course, right? It's too much money chasing too few goods. So this can come from either side. It can come from demand or it can come from supply. And certainly with respect to the COVID shocks that we've seen coming through, a lot of that are negative supply shocks. And we are seeing this in logistics and shipping and all of it, right? But you also saw a very, very broad commodity price strength. And that's where the dollar is so important. And it's why dollar inflation figures matter so much to global inflation psychology, because the fact is a huge, huge amount of global trade is transacted in dollars. That includes base commodities, and it includes lots of other things, intermediate goods and whatnot. And so dollar inflation figures are extremely important. Now, that does not mean that for a UK investor, sterling inflation figures aren't important. They're extremely important. And in fact, ultimately, with respect to your portfolio, they're probably more important. Yeah. Assuming that portfolio is primarily denominated in sterling assets. However, with respect to the general outlook for the global price level, the dollar really is the benchmark here. But certainly sterling has had its own issues. And in the past, of course, you had occasional large devaluations of sterling, where what was happening with dollar inflation and interest rates wasn't really relevant at all, right? In 1992, when sterling suddenly falls 20%, or round numbers, I think it was about that much. It didn't really matter what was happening with dollar inflation prints at the time. Yeah. So yes, you have to look at the big picture, which is primarily the dollar picture. But yes, regardless of where you are in the world, local market conditions can also have a significant influence from time to time.
When you're looking at significant levels of, say, annualized CPI then for the dollar, so you're looking at the annual levels of inflation, which is kind of like the big figure inflation metric, which people sort of rely on as shorthand. Are there any specific levels that you would be thinking that gold would be most sensitive to, or is this a wrong question to ask?
It's really hard to know, and the fact is that realized inflation does have a relationship with the gold price. It kind of has to by necessity, after all, right? Gold is a store of value, but it's a very unstable relationship. It's not a tradable relationship, in my opinion, and indeed, I mean, only very long term do you see with a high level of certainty that the two are indeed strongly correlated, but only in the long term. On a more investable investment horizon, you find a far stronger relationship with real interest rates. Okay, so that's the level of prevailing interest rates, and in particular, long-term interest rates, and inflation expectations, which can be seen through break-even inflation rates in the inflation-linked debt markets. In dollars, those are the TIPS securities. In the UK, you have your index-linked gilts and so on. That's the stronger relationship. Now, historically, and this was seen in the 90s and 2000s, and it was also seen to some extent more recently, there's been a level that I do believe has been meaningful in terms of sort of the inflation psychology and gold psychology changing. Yep. And that's when real interest rates move below 2%. What I've discovered, and you can sort the data however you want, but what I've discovered is when real interest rates hold below 2% for a sustained period of time, gold invariably finds its way into a bull market. Now, obviously, we're well below that level now, right? Real interest rates are outright negative. And so, of course, gold, by that logic, by that historical observation, should be in a bull market, and it's not. Now, we did see that big rise to $2,000 an ounce some months back. That was a while ago now. Yep. But it could be that the gold market was sniffing this out and was already beginning to adjust. But we've given it all away now, which I think is surprising. I would not have expected that. And again, one wonders why that is happening. I've offered an explanation before, which is that the market still appears inclined to take incremental risk for yield enhancement in the form of high yield debt and in the form of growth-oriented equities. And as long as market psychology is willing to take that incremental risk for incremental return, gold's not going to seem particularly attractive. So we're going to have some risk aversion thrown into the mix, in my opinion, for gold to get back into a proper bull market, which it should, as long as real interest rates remain this low.
Yeah, and that reach for yield was something we dwelled on last week in our previous episode of Southbank Live. Do feel free for anyone watching to refer to that. It'll just be on the playlist that should be on your screen. I think it'll be on your right, where we did take a look at how the interest that one can earn in high-yielding debt security, so in junk bonds, from the less credit-worthy corporate debt market, how it actually gone even lower than 6%. I believe it's bounced a bit. I think we're back to around 7% for those high yield bonds. However, the fact that it went below 6 was illustrative of just how much demand there was for it. And there wasn't much risk aversion, as you were saying, John. I mean, people are still buying lots of junk debt. They're not afraid that these companies are going to be unable to service them to some degree. Now, referring to what you said earlier about how important the dollar is, we did get another question about this. For anybody who is watching live, do feel free to comment or ask any questions in the chat box. We shall try and answer them, though we do have a lot of questions to be getting through this week, as this has attracted quite a lot of attention. Nathan asks, Dear Boaz and John, for gold to catch a bid, do we ultimately need the dollar to break down? The big bull market of the 2000s was driven by a falling dollar, referring to the big bull market in gold. If so, what would cause the dollar index to weaken significantly from here? More money printing. But given the attitude of central banks around the world, notably the European Central Bank, does the Fed not need to print more than the next bank for the dollar to lose its value versus other currencies? Can you see gold getting back above $2,000 with any other scenario than a weaker dollar or outright market fear and panic? Nathan, very good question indeed. A lot of good stuff in there, especially about sort of central banks being competitive with how much money they're printing. For the Fed to make a difference, does it really need to print more money than the ECB? Or not? I mean, there's lots of stuff in there, John. Take it away.
Well, first of all, I mean, look, there's not a one-to-one relationship between money printing and how much of that money is actually going to get pushed through the financial system into the real economy where it can affect real prices. These are extremely complex mechanisms that are very, very opaque. And in fact, you can really only analyze in any meaningful detail in retrospect. You can't really do it in real time. It's impossible. And so what we have to look at are the sort of background sort of context in which this money printing is taking place. And it's important to remember that the US is a huge net importer, reliant on foreign capital. And that means that if US interest rates are not more attractive than those available around the world, the dollar is going to have a natural tendency to decline. And right now, of course, there's not a whole lot of difference, right? Short rates are essentially zero everywhere you look. And so you're in an essentially neutral environment where other factors equal, if the US is creating roughly the same amount of liquidity as everyone else, the dollar should be in a downtrend. And yes, other factors equal, if the dollar's in a downtrend, then the price of gold and other commodities that trade in dollars is likely to be trending higher. Now, that said, if you actually look at the early 2000s when that big gold bull market got going, interestingly, during the first couple of years of that, gold was rising versus all currencies. It was not merely rising versus the dollar. And indeed, I did an analysis way, way back in 2003 when I basically said, look, this is the first time in a long time. You had to go back to the late 70s, early 80s. The first time in a long time that gold was rising versus all currencies, right? Rising in price versus all major currencies. That was highly unusual. And I said, this may be the best confirmation we've got that the floor that gold put in the early 2000s is a historic floor, right? Is the beginning of something very, very significant historically for gold. And indeed, that call proved correct, as we now know.
Yep.
So I don't think it's strictly necessary for the dollar to get into a downtrend here for gold to nevertheless be able to push higher. everywhere you look. Central banks are doing more or less the same thing. And historically, that thing has been bullish for the price of gold. So it's not just a dollar story, it's a global story. But yes, other factors equal, I would expect the dollar to get back into a downtrend here. And yes, other factors equal, that should support the gold price.
That's interesting, John, because when we're talking about risk aversion and how we're going to need to inject some fear into the market for gold to really start getting its strength back. I mean, is that normally a risk averse environment would be when the dollar would rise, correct?
Other factors equal, yes. And that's because what you have, again, the world is still very dollar centric in terms of how it sources its leverage. And if you're getting a general deleveraging, then other factors equal, people have to put up more dollar collateral against whatever risky asset positions they've been taking. So in the first wave of risk off, you tend to get dollar strength. That said, you tend then to get dollar weakness thereafter. Why? Because people realize that, in fact, they need to move into safe haven assets. And those safe haven assets, in many cases, are not necessarily dollar nominal assets, right? You're moving out of, for example, the high yield debt market is overwhelmingly dollar denominated.
Yes, big
And
time.
if you decide, well, hold on, I'm going to cash out my high yield and just go into a diversified government bond portfolio. Well, sure, okay, you're selling some dollar high yield for dollar treasury securities, but then you're also going to be buying some euro debt securities, some Japanese debt securities, so on and so forth. And that on balance will then be dollar negative. And so you have to look at the mechanics of how that takes place. The first thing people do is they simply need to raise that dollar collateral however they can do it. But then when they say, okay, how do I want to structure my more defensive portfolio? That decision, which is then executed over a multi-week or even multi-month period, is not necessarily dollar positive at all. And history suggests it could be quite the opposite.
Right. Now, we shall be returning to gold shortly, but as it is 22 minutes past 10 in the morning now, I did think we'd cover a couple other topics. We shall be going back to it, as I say. Some very interesting stuff we've got coming up when it comes to the manipulation case. I do know plenty of our viewers are very much interested in who or what might be manipulating the gold price. And of course, we do have a very big anniversary coming up on Sunday. But John, we did run a couple of polls on our social media accounts. If you are watching, do feel free to give us a follow on Twitter or on Facebook. We do post a lot of our content up there. And as I say, we did poll some of the topics which viewers might be interested in watching. And in terms of what people were interested in, interestingly, it was different on Twitter than on Facebook, though we did ask them the same question. So the people on Twitter were more interested in why the oil prices started softening, while people on Facebook were more interested with why Bitcoin has managed to strengthen again after a very brutal sell-off earlier in the year. Now, when it comes to the oil price selling off, I think this, to me, it kind of goes hand in hand with the gold price selling off as much as it has. Generally, it's we've seen a commodities negative move in the market. Oil and gold are obviously used for completely different things. However, they are very, very important commodities for different reasons. And I think them selling off together is quite interesting. I would say, is the oil price selling off because the oil market detects that there might be more lockdowns in the future would be the reason. But John, what do you make of it, and what do you think is behind that move?
Oil has been buffeted by both macro, but also some idiosyncratic factors in recent weeks that have to do with OPEC plus, as they call it now, negotiations. That is OPEC plus, including Russia, and that's been a big factor. But let's step back from the chart, right? Oil rallied a long way. Okay,
Yeah, big
it
time.
was hit. I mean, come on, it came back from zero, right?
Well, it came back from minus 40. Yeah.
That was, yeah, okay, fine. But that was a supply shock aberration, which is not the sort of thing you would expect to see repeated, and had no real meaning for the broader investment market. Had that said, oil did come off a lot, and it stayed low for a long time before it began to rally back. And when it rallied back from sort of that level that it stabilized at, I mean, it roughly doubled in price. I mean, that was a big rally. Okay. Yep. And so, and obviously, when you have huge moves in the oil price, OPEC always needs to have a discussion regarding, okay, what does this mean for our production quotas? Do we like the price being this high? Do we want to produce a bit more? If so, who gets to produce how much more? There's a lot of politics in that, most of which occurs completely behind closed doors. It's very difficult to know what precisely is going on and how those decisions are made. And this particular time around, I believe it was the UAE, which felt that they were not receiving their fair share of production volumes, and they wanted to renegotiate. And anyway, it dragged on a bit. That now appears to be behind us. It appears that they've settled that dispute and other related disputes. And so now, assuming the idiosyncratic figures have kind of washed through, we're left with the macro picture. And while inflation may be elevated currently, leading indicators of growth around the world, they're not exactly great, right? They've softened now.
Yes.
So you've had this COVID bounce, and the COVID bounce is very much in the rearview mirror. And in places like China, they're already easing credit conditions. And so I think it's worth seeing this gentle softening of the oil price as a potential indicator that this global demand is simply coming off a bit now.
Yes, it does seem. I wonder what we'll think of it in, say, 3 months' time, because I imagine whatever the oil market is sort of worried about is probably something we're going to encounter in by the end of the year. But we'll find out. We'll find out. John, moving on to quite a different commodity, though everyone calls it something different. Some people it's currency, some people it's an asset. Well, Bitcoin is Bitcoin. I think it's unlike anything that we've really seen before. So maybe calling it these other names isn't the best idea. But we have seen quite a surge in that. There was something of a sell-off that took place yesterday evening. But just in terms of where we are, we're still back in the sort of the 40,000s. So which is a very big number when you want to consider that a year ago we were only at 4,000. So what's your take on it? Because I think it comes back to the risk aversion that we were talking about earlier. So I don't think people are feeling massively risk averse right now if they're happy to buy Bitcoin at $40,000. That would be my view on it. But what do you make of it?
Well, I mean, you mentioned Charlie Morris a few moments ago, and he's produced a lot of thoughtful research on Bitcoin, and a decision that he arrived at several years ago that I largely concur with is that Bitcoin is very much a speculative thing, right? There's no way it can't be, given how new it is, and the fact that it doesn't really have end use cases, right? At least not yet. And so then the question you have to ask is, okay, if that's the case, what does it correlate to? And no surprise, it correlates to other forms of speculation, in particular in tech generally, and in e-commerce, and these sorts of decentralized finance as an investment theme generally. And so that's part of what's going on here, in my opinion. But you have to be very careful with Bitcoin, because even though in theory it's very decentralized, in practice, a very small number of players appear to dominate the market. They are big miners and they are big exchanges, and they account for arguably 95% or more of average daily Bitcoin volume. And so while it's theoretically extremely decentralized, in practice, the day-to-day trading and volatility is dominated by a small number of insiders. That's a dangerous market for anyone that doesn't have some amount of information regarding what those insiders are up to. So again, this is not a view one way or the other. It's just an explanation of the way the market works. And if you think that gold can get slammed easily at an illiquid time, or for that matter, could suddenly rise dramatically at some illiquid time, the potential for Bitcoin to go through those sorts of surprising sudden swings with no real explanation available is all the greater. So regardless of how you feel about Bitcoin, just be aware that the volatility is not going to go away. And indeed, until Bitcoin does perhaps, and this is very uncertain, establishes itself as an actual money with lots of actual use cases where people are accepting it as a final means of settlement, until that begins to happen, it's going to remain extremely volatile and speculative, certainly more so than gold.
Yeah, it's interesting, the blend of gold and Bitcoin. As you did mention there, Charlie Morris has done some very good work here at Southbank Research when it comes to gold, Bitcoin, and how they might complement each other in a portfolio. He calls it the bold portfolio. If you're interested in that, do feel free to find him on Twitter. I believe his handle is Atlas Pulse for those watching, and he does gives a great analysis of how gold and Bitcoin might complement each other, because he sees them sort of as this blend of both the ancient monetary technology and modern monetary technology, and mixing them together can create a very interesting portfolio. But John, when people do like to compare gold and Bitcoin, I know you yourself don't like comparing them together as Bitcoin being the greater version of gold, as a lot of the hardcore Bitcoiners would say. And I would very much agree that Bitcoin is not gold. As I said earlier, it's not the same. They're not the same things. As you said to me quite recently, one of these things is created by man and the other one isn't. So it'd be a bit like comparing, say, a plane to an aircraft. No, sorry, not a plane to an aircraft, but a bird to an aircraft. These are not the same things, even if they are in the sky, right? And when you're looking at them from a mining perspective, I'd be quite interested in this, because a lot of people say Bitcoin's terrible for the environment because it uses a lot of energy, but then the gold mining sector uses an awful lot of energy as well. And when it comes to the centralization of the companies which really dominate it, your Barracks and the like, I mean, they're pretty centralized too. And as we've been talking about the market and how liquid or illiquid it is, and some of the big players that are in it, I wonder if the comparison of some of the market structure, or at least the centralization of some of the players in it, might be similar. Am I barking up the wrong tree there?
Well, I mean, look, don't get me wrong. I mean, there is certainly an element of centralization in gold mining, right? You have a handful of mature major companies that produce the bulk of annual supply, but annual supply is only maybe 1.5% of the stock.
Right.
And therefore it's the stock, primarily demand for the stock vis-a-vis other assets in the dollar, which is going to determine what happens to the price. And keep in mind, these mining operations, they are the product of years and years of capital investment, and you don't just turn that off. Right. These are not, gold mining is not a light switch. You don't just say, oh, gee, the price is rising, I'm going to produce more. It doesn't work that way. And it also doesn't work the other way. Right. It's like, oh, I'm going to suddenly produce less. It's like, no, you have a production schedule that you more or less have to keep to. Now, don't get me wrong, large price swings over multi-year periods, of course, they're going to have an effect on the underlying mining supply and investment and expansion and whatever else. OK, but they're not going to have any real effect on day-to-day anything. Now, the other thing I would say, though, is that, of course, mining is energy intensive, right? If you're going to get ore, from deep in the ground and bring it up and refine it and everything else, that requires a huge amount of energy. That energy costs money. Therefore, you're only going to do it if the gold price is sufficiently high vis-a-vis other assets and potential investments. You're really only going to expand mining capacity and use all that energy if it's sufficiently attractive to do so. The existing gold stock, which is basically a bunch of bars and coins and chains, if you want to include jewelry, the existing gold stock requires nearly zero energy to maintain. Human beings do not have to be on this planet at all. We don't have to burn down one tree. We don't have to, burn, one barrel of oil. Or anything else for that matter, in order to maintain that gold stock. It is maintained by Mother Nature. Now, don't get me wrong, past energy expenditure was required to get that naturally occurring gold stock into a concentrated form that we can easily use as money, as a store of value. But the future, right, the ex ante further cost of maintaining that gold stock approaches zero. You don't need to mine it. The gold monetary base is already there. The same cannot be said of Bitcoin. Simply for the Bitcoin network to be maintained, for Bitcoin to exist at all, even if you're not growing the stock, requires energy, a lot of energy. And this is where I think ultimately longer term, gold has this advantage vis-a-vis Bitcoin, in that the base layer, the monetary base of gold itself, requires essentially zero energy, whereas simply to maintain that base layer, as it were, of Bitcoin underneath whatever financial superstructure you build on top of it, the base layer is already consuming a lot of energy just to exist.
Yes. I wonder, as a counterpoint, though, if we're talking about, for mining and securing the network. So all of this mining is going on, of course, just to allow transactions to clear across the Bitcoin blockchain and to ensure that they are secure. That's what the mining difficulty adjustment's all about. But all these gold bars, John. I mean, it was probably not an easy way of quantifying it, but securing all of those gold bars. I mean, that's a lot of private security or public security that you got to hire.
Yes and no. Gold's density of value is very, very high. And so you can have a vault, which is not very large. That vault can be in an extremely safe jurisdiction with, very, very strong rule of law, property rights, all that sort of thing. I mean, Switzerland's a classic example of this.
Yeah.
And you can fit into a fairly small vault billions worth of gold. Gold's value density is just so high. And I have visited a couple of vaults in Switzerland. And you walk into the vault, and the vault's not particularly large, but the other thing that strikes you is that it's also not necessarily particularly full. There is a lot of precious metal vaulting capacity out there that exists, spare capacity, if it's necessary to be used. The incremental energy cost of filling up those vaults approaches zero, because all of the infrastructure is already there. It's already been built out. You already have this network of ultra high security vaults. And there's one very famous one, and someone I know is involved in managing it, which is a former Swiss military bunker.
Yeah.
which again, which is a natural natural fortress, excuse me, high up in the Alps. And Mother Nature built that. Also, in a way, right? Bitcoin has none of those natural advantages. So don't get me wrong, Bitcoin does have certain advantages, absolutely. But this natural energy network cost is a relative disadvantage that Bitcoin has vis-a-vis the existing gold network.
Yeah, I mean, as you say, John, with the energy density that the value density that gold has, all of the gold that we've ever mined wouldn't fill up a particularly large space if one had it. And of course, these vaults in Switzerland, I'm sure there's plenty of room still in there. That you could probably put private jets and lots of diamonds and all the goodies in there. But I guess it comes back down to the concentration of actually storing it. So, if we were talking about, imagine if Satoshi had never told anybody about what he had created, and it was just his computer that was running the Bitcoin network. Well, it wouldn't use much. He wouldn't be consuming much energy to mine it. But the issue is scaling it so that every Bitcoin is secure. And similarly with gold, not everyone can get access to a Swiss vault. And if somebody just owns a little bit of it, they might still need to invest in some security, be it a safe or be it private vaulting services, which I think would cost a bit of money.
You'd be surprised, though. You would be surprised. There are many firms that specialize in enabling people to purchase and arrange for the secure storage of even very small amounts of gold.
Oh yeah,
in extremely high security vaults in Switzerland and other safe jurisdictions. Now, that said, some people might prefer to keep it at home, and they might prefer to pay a little extra for home security. A high quality safe, probably one that's bolted into the structure of the house in some way, so it can't be easily lifted out. Certainly fireproof and whatever not, if you have precious documents in there as well. And then you might want a home alarm system. You might want to have a gun in the house, whatever it is. Yes, okay, fine. Those things cost energy and they cost money. That's absolutely true. But there is this option that pretty much anyone anywhere in the world has, which is to go ahead and own some gold stored in a very, very safe jurisdiction for extremely low storage fees that are far, far lower than those implied by maintaining the Bitcoin storage network and transaction network.
Yeah, and all of the so for somebody who's owning a safe at home, it's a one-off cost. It's not a constant yearly, annual thing or daily thing as it is with the Bitcoin blockchain. But of course, I do feel we've gone on a bit of a tangent here, John. It is great to discuss gold and Bitcoin and how they're maybe similar, how they're not. But we should get back to the topic at hand, as of course we were talking about gold specifically earlier on. There's have received a lot of questions on gold ahead of time, not so much in the chat this week, which is fine because we do have plenty of questions. Right, gold manipulation. Lots of questions on this. Where should one begin? I think actually before we get to that, John, could you tell us about a certain conversation you had with a high-ranking member of the CFTC once upon a time regarding precious metals manipulation? Because I think it's quite revealing what the chap in question said.
Well, a little background, first of all. I mean, I've been following the literature on suspected gold and silver price manipulation for many years. And I've learned a lot, right? And there is indeed, and I think anyone has to acknowledge this, there's a lot of circumstantial evidence that some form of manipulation, however minor, some people think it's very major, has been going on. But I stress it is only circumstantial evidence, nothing definitive. And so I've never really been able to make up my mind either way. That said, I've been curious throughout the period, and I did have one conversation. Actually, it was two conversations, but one conversation was far more revealing than the other. So I'm going to focus on that one with a former member of the US CFTC, that is the Commodities and Futures Regulator, named Bart Chilton. Now, his name has showed up in lots of the work that I've just referred to in general, because he was involved in the silver manipulation investigation that went on for several years. Now, Bart, he did die a couple of years ago, so any remaining secrets have kind of gone with him, as it were. But I had a conversation with him once here in London, and he was very open. He was very open about it. You know, we were at an event at which we had both spoken, and we were having a beer and chatting. And so I casually asked him about it. I said, you know, what were your thoughts on that silver manipulation case? Because you concluded in the end that indeed there wasn't manipulation taking place. You know, what did you think of that conclusion personally? Was it, you know, did you disagree with the majority decision, et cetera, et cetera? And he looks me in the eye and he says, John, I've never seen such clear evidence of manipulation in my life. And I thought he might have misspoken. Like, what do you mean by that? Then how could you possibly find that there wasn't manipulation? He said, John, you need to understand the difference between manipulation on the one hand as something where, you know, someone's fiddling around in the market in a way that doesn't really make sense, it is not profit maximizing, and manipulation in the legal sense that can result in regulatory action or disciplinary procedures, prosecution, fines, whatever. The two are not the same. In order to establish manipulation as a legal act, something that has been done that is illegal and prosecutable, you must establish a clear, provable profit motive, because otherwise it's not illegal. Manipulating a market is only illegal in the US if you can demonstrate it resulted in a profit. It's not illegal if you can't demonstrate that. And then the bells really went off for me, right? Then I realized what's going on here. There might well have been, and Bart was very open about this, there might well have been someone systematically manipulating the silver market for years, but they didn't make money. So then you have to ask yourself, okay, if somebody was manipulating the market for years but not making money, who are they and why were they doing that? And you start to wonder, okay, maybe the market was being manipulated not for profit, but for some other reason. And that's when you start to go down the rabbit hole. Now, and again, why you have to, I believe, give at least some credence and credibility to the circumstantial evidence that some manipulation has been taking place on again, off again through the years.
Yeah, a lot of rabbit holes we could go down there. Very interesting about manipulation in the legal sense and whether or not it needs to be for profit for it to be actually prosecutable to some degree. I guess a sort of masochistic manipulation where you're burning your own money in order to get the market down is all right. Though, of course, we're not recommending anybody tries that. I mean, John, and that was looking at silver, but of course there are plenty of parallels with gold, and you see plenty of the same allegations get thrown around for the gold market. I mean, let's review what would drive an individual to want the silver market down, or an institution, as it would need to be,
Well,
as not for profit. I mean, it's for in the public interest, perhaps.
Well, look, the silver market is much, much thinner than the gold market.
Yep.
So if you do want to manipulate something, silver is a lot easier to manipulate with less capital. And so if you're not interested in making money, but you just want to manipulate the market for some reason, you're going to get more bang for your buck in the silver market. And then you can perhaps hope by extension that because people do look at the gold silver ratio, that maybe if you're slamming silver down, maybe, in sympathy, gold's going to follow along. And it's sort of a, tail wagging the dog sort of thing, because of course the gold market is so much bigger and more liquid. Yes, I mean that's one possible explanation of why maybe the silver market has attracted more manipulation through the years. At least that's what the evidence appears to bear out. But then, as we've just seen, gold appears to attract its share of that as well from time to time. Very, very curious large orders going through the market at very, very illiquid times. That it seems a very odd development if people are truly simply profit maximizing. So what other purpose could be served? Look, I've thought about this, and I'm hardly the only one to have thought about it. But yes, the fact is that economic policy is not really intended to be profit maximizing. It's intended to serve, whatever political purposes are behind those economic policies. It's true of fiscal policy. It's true of monetary policy. And to the extent that governments intervene in the foreign exchange markets, to the extent that they intervene in their own bond markets, those are two things that we basically take for granted. Because they're not always admitted to in real time, but we know they go on. Sometimes very, very out in the open and officially, sometimes very in the dark and unofficially. We know it goes on. It's always gone on. So if governments and central banks are openly, if not always openly, active in the foreign exchange and bond markets, why shouldn't they necessarily not be active from time to time in the gold and silver markets if they think that by being involved in those markets, they might be able to send certain signals regarding what they would like currencies to do, what they would like interest rates to do? We know that these relationships exist. And so why not use all the tools at your disposal in order to try and achieve your policy goals? I think it's a fair question worth asking. And so I have, again, as I commonly say when I get onto this topic, I have no privileged information, but I do have access to history books and also articles that have been written on these topics, some of whom have been written by eminent professors at very esteemed academic institutions investigating foreign exchange manipulation. And yes, occasionally gold comes up. Now that was more the case back in the 60s and 70s.
Yep.
But the idea that somehow it just never happens at all anymore for any reason, that actually seems like a bit of a stretch to me. If governments and central banks are intervening everywhere else, which they admit to, why would they not perhaps intervene from time to time in the gold and silver markets if they thought it served a policy objective? Why not?
Yeah, it's a fine question to ask. And when we see moves like we did over on Sunday, you do wonder what exactly is going on here. Now, of course, it's very, very easy to be throwing around the word conspiracy theorist. It has been for a long time now, and people are going to keep using that against people who believe that there may be some, even ask the question. Like yourself, John, and like myself, that is the manipulation going on? Could there be? It doesn't seem that out of the ordinary when one thinks about it. But John, when you're talking about the unofficial interventions into things like the foreign exchange market, and you said that sometimes it's really quite out in the open, could you give us a couple of examples of that?
Well, the most classic out in the open examples are when you actually have conferences by governments to get together and to try to reset exchange rates in a way that is deemed politically desirable, at least by the majority involved there. You saw this with the Plaza Accords in 1985, and then 2 years later with the Louvre Accords, 1987. Those are two very prominent examples. You could argue also that the attempts to kind of paper over what was left of Bretton Woods after the gold window was closed in 1971, and the Smithsonian Conference and so on, those were all very, very out in the open, and there were interventions taking place, sometimes coordinated across many countries, sometimes, however, individual countries. And it's the latter where things frequently take place quietly and in the shadows. This is certainly true of emerging markets that are trying to maintain some whatever level of stability or whatever policy objective it is for their currencies. You see lots of unofficial, quiet intervention take place. But then you've also seen it in much larger economies. Obviously, the UK has been involved in this, right? Regarding the ERM, right? Clearly what was going on there was official in nature, but it wasn't always disclosed in real time, right? Do governments and central banks want the big speculators around the world to know what they're up to all the time? Of course they don't, right? They'll be front run every step of the way. And so there was a fascinating paper that I read some years ago on this topic, and it was actually written by a committee of authors, several of whom chose to remain anonymous. And I believe the only explanation for that is because they were current or former officials who'd actually been involved in the interventions. And the paper was basically a chronicle of major foreign exchange interventions through the decades. And they compared the relative success of the official interventions and the unofficial intervention. And they found that the official ones were far more effective, but that the unofficial ones were far more common. And of course, some of them were effective.
Yeah.
And it made for an interesting read. And while that paper did not specifically reference gold, if you simply threw gold into the mix as another currency, it makes a lot more sense, I believe, what you've seen historically, that is some of the strange developments from time to time in the gold market. They fit much better in the context of that paper than they do in the context of gold being a market that economic officials never touch.
Yeah, that sounds like a very interesting paper, John. I think I'd like to take a read of that at some point.
I'll send you a link.
Oh, thank you. And I think we'll share it if in our next episode if we get a moment. John, am I overthinking it? I mean, when you why would a government want to do this? Well, would want the gold price to be lower just to assert more confidence in its own paper currency. Is there any more to it than that? Or is there any other reasons why a government would want precious metals prices to be lower, or not even the government? It could be just a central bank or a ministry of finance inside the government rather than official state policy. Is there any more to it? Is there any other reason why a state would want precious metals prices to be lower other than just to make their paper money seem a bit more valuable?
I've had a number of conversations with economic officials over the years from many countries, and working in different capacities, and working for central banks, working for fiscal authorities, working for trade representatives, negotiating tariffs and customs and WTO, that is World Trade Organization agreements. So I've had a number of conversations, and one common theme, there are several common themes, but one common theme relevant to this conversation that has come out is that economic officials simply don't like volatility. They accept that asset prices are going to move around. They accept that foreign exchange rates are going to move around. They accept that there will be trade disputes from now and again, tariffs, quotas, you name it. They accept all of that. They just want to keep it to a minimum. They like a world that they understand. They like a world that they feel they mostly control, at least preventing extreme moves in either direction. So this idea that anyone would simply want precious metals prices to trend lower forever, I don't think is true. The idea that they want them never to move forever, I don't think is true. What I, however, have some sympathy with would be the view that economic officials might prefer that precious metals prices simply remain within some sort of reasonable range over some period of time, because otherwise they might send signals and influence other markets in ways that those economic officials would not welcome. That is, the volatility in precious metals might spill into foreign exchange generally, might spill into interest rates, and that's where it becomes a real issue, right? The cost to which governments finance themselves.
Right. Yeah, there is a more more nuanced take on that. It is interesting, the sort of the will to control, and how far somebody with a public checkbook might go in order to try and assert assert stability from their end on financial markets in general.
Well, look at how much money the Bank of England spent to try and remain within the ERM back in the early 90s.
Right.
Look at how much money the London Gold Pool spent trying to hold Bretton Woods together in the late 60s and early 70s. I mean, the numbers are large, right? They're properly large numbers, and they were spent in activities that were in some cases disclosed, in some cases less so. But they were large numbers that were spent without any regard as to any profit that was sought. Rather, the opposite. How much are we willing to lose in order to achieve some policy aim?
Yeah. Yeah. It's a yeah. You do what one does wonder if there is if there is consistent manipulation going on, just how much money has been lost trying to keep everything together. Now, John, I do realize we are getting on full time, but it's 5 to 11. I would like to just go through a couple of questions if we can before we round it up. This was just regarding a price manipulation. We do have plenty of these. David asks if the spot price is being suppressed by central banks who have little concern, unlike short-term traders in the gold market, about making money, so they're price insensitive, then are us gold bugs fooling ourselves in thinking that we can protect our wealth? In which case, will investors in gold mining stocks, even if correct in their thesis, will it all be to no avail? Well, John, manipulation can't last forever.
No, it can't. No, it can't. All they're doing is buying time, right? The gold market is a finite market. I mean, obviously, okay, fine. There is some stock being added to some flow adding to the stock through mining operations. But the fact is that this is true of anything that's finite in nature, right? You can't, unlike a company that can issue more shares if they think their stock price is overvalued. You can't suddenly create more gold.
No.
And so eventually the manipulation game will be over and the price will spike higher. Now, I don't even know with certainty a manipulation game is being played. If it is being played, we have no idea just how much ammunition people are in order to keep playing that game. And we have no idea, therefore, how long it will last or how big the ultimate correction will be when the game is over. But we just know that optionality, that asymmetry is out there. And so I would never advise anyone to not be invested in gold as the premier safe haven asset, just because they fear a little bit of manipulation might be taking place around the margins.
Right. Another question regarding manipulation. Graham believes that gold is clearly being trashed by the bullion banks, who are desperate to clear their short positions in the gold price now that Basel III, which we have discussed in earlier episodes, has stopped all but the London banks until the end of 2021. What is also clear is that these bullion banks are operating in unison and thereby acting as a cartel. There is a law against cartels and against insider trading. Why doesn't someone sue them? Well, would it be because, if you're not provided you're not making any money, you can't be prosecuted, John?
Look, I mean, the gold market is not regulated in the same way that securities markets are. It's a much more lighter touch regulation, and even Basel III coming into existence doesn't really change that. The LBMA operates pretty much the way it wants to operate, and calling it a cartel is well, look, I mean, academics who study these things, they usually claim that if you have fewer than 10 players in a market, it's almost certain that they're colluding. And if you get down to 6 or less, it's almost automatic that they're colluding. Anyways, it's oligopolistic theory or whatever you call it. In any event, I think that the bullion banks are few enough in number that it would be surprising if they weren't working together That's not necessarily for nefarious purposes, right? It's just natural. When you have that few players, that few people in the same room together, of course they're going to behave in a similar way because they're all going to be profit maximizing for their own benefit. And while they may not necessarily make a profit in any and all markets in which they operate, certainly they'll try to act in a way that when it comes to their overall businesses and portfolios, that they do in fact over time try to maximize those profits. So suggesting that the bullion banks are colluding in a sense that is not necessarily illegal, but to the idea that they're not talking to each other, I think is, well, of course they are, right? I mean, why shouldn't they be? So I think it's very difficult to bring legal action against something like that because you end up in a situation where you're trying to prove something that, even if provable, isn't necessarily illegal because of the relatively unregulated nature of the bullion markets.
It's very interesting when one thinks, what is illegal? What could you get away with? What could they do that would really push it over the line before somebody would really say something? We do have a couple more questions here, actually, on the manipulation. There was a question which was specifically when it comes to technical analysis, when it comes to the support and resistance. We don't have a good chart up at the moment, so I think technical analysis discussion probably wouldn't make much sense if we were just talking about it. Anthony, we shall try and do that in a later episode, however.
Sure.
And there was another question when it comes from PF, who says, I've been reading for years about alleged gold and silver price manipulation by the bullion banks. Looks like they were at it again last weekend. However, I don't really understand how they make money by driving the price down, because nothing I've read spells it out in words of one syllable that I can understand. Could you ask John to use a very simple arithmetic example to illustrate what happens when the manipulation takes place and how the bullion banks make money from it? It's always seemed to me that they should be losing money if the price is going. So what do they need to do to avoid that result? Now, of course, we've not said it is. We don't know who or what may be manipulating precious metal prices. A lot of people do think it's bullion banks, and as you've said, John, if somebody was trying to manipulate the price, it doesn't look like they're making much money from it. But is there anything you would say to PF when it comes to sort of simple arithmetic when it comes to manipulating precious metals prices and how someone can benefit from it?
I mean, as discussed earlier on this call, right? The simplest strategy, if you're manipulating a market and if you want to try and profit from it, is you try to use a market dominant position to occasionally slam the market one way or another and try to catch other people out, try to create patterns in the charts that either encourage people to buy or frighten people into selling. And then you take the opposite side, right? Because there is a herd mentality in markets. And if you think you can direct that mentality, then you can use manipulation to your benefit, both to the upside and to the downside. It's probably a very difficult game to play. And if you get it wrong, you're going to lose big. But if you think you can successfully manipulate the herd, then why wouldn't you try to do so? So it's possible that there's an element of that. That said, I actually think it has more to do with the bigger picture. And again, it's a huge if big players in the bullion markets are manipulating it from time to time, I would suspect it has more to do with their overall book. That is, their interest rate positions, their currency positions. And they see gold and silver somehow as a means to an end for the bigger balance sheet portfolio. And so I think that would be more likely to result in something interesting to look at if you're looking at the bigger picture there. But it's so difficult to know, right? Are banks long or short interest rates? Well, they tend to be naturally long because their balance sheets. Balance sheets tend to be naturally long, the market, as it were. Foreign exchange is different. It's not an asset, just a ratio. So that's a more difficult one to understand in that regard, although you could say that the base currency for a bank then becomes an important metric vis-a-vis their position in other currencies. I think that's where one would have to look. But again, to try and get ahead of that in real time and understand what's really going on is probably impossible. But I would try to look at the bigger picture. You can lose money in one market, but if it allows you to make money in many other markets you're involved in, why wouldn't you do that?
That's very interesting. Yeah, it'd be very interesting to see how you would create a portfolio for if you imagine that there is one entity that is messing around in the gold market or the silver market, how they would be making money elsewhere. What would be their broader portfolio? That would be very interesting indeed. But as you say, it'll be very difficult. Now, John, we are of course getting on for time here, so we shall close it off soon, I believe. Thank you all to everybody who tuned in, and I would like you all on Sunday to make note that it will be the 50th anniversary, the golden anniversary of when Richard Nixon closed the gold window. So when the world went entirely off a gold standard for the first time in history, that will be 50 years ago on Sunday. The golden anniversary of fiat money, or at least the golden anniversary of the fiat money world that we live in today. Nixon famously interrupted a repeat of Bonanza and was very worried about irritating people by turning off Bonanza during the Sunday evening, which of course was very, very popular at that time. I think Bonanza had been around for over a decade at that point, and it only lasted a few years after, funnily enough. A great show, but he went and interrupted it 9 p.m. and said, by the way, we're putting wage and price controls on, and the gold window will temporarily be suspended. So it's been 50 years now, very temporary indeed. Hopefully it will be temporary, and maybe we'll see it reinstated at some point in future. Probably won't be at $35 an ounce, though, I would reckon. No. But it will be on Sunday. So if you are somebody who enjoys drinking a beer every now and then, I would suggest a golden ale on Sunday. But that is all from us for the moment. John, thank you so much for joining me.
Thank you, Boaz.
Thank you for watching, and please subscribe if you did enjoy this. We'll be doing more of these in the future, and I hope you'll join us then too. But that's all from us for now. Bye-bye.